Welcome back to the deep dive. We're here to take the latest complex financial filings and, break them down into something useful. Today, we are definitely tearing into a big one, the Q3 2025 10Q from Meta Platforms. That's the quarter ended September 30th.
Yeah, a lot going on in this one.
Right. And our mission, as always, is to get behind those top-line numbers, really unpack what's driving the strategy and, frankly, the real financial picture. And you find a head-scratcher almost immediately. I mean, you look at revenue.
Incredible numbers.
Just soaring, right.
Wow.
Up 26% year over year, hit $51.2 billion. Huge.
Absolutely staggering revenue. But then you look a line or two down, and that's where the shocker is, net income. It just collapsed.
Collapse is the right word. It went from almost $15.7 billion in Q3 last year down to $2.7 billion this quarter.
A massive drop, over 80%, closer to 90% actually.
So that's the mystery we're diving into. How does this hugely profitable, fast-growing giant see its net income just evaporate? Is the core business secretly falling apart? Or, is there something else buried deep in those footnotes? A big financial event.
Well, spoiler alert, it looks like we're hitting deep into some tax and legal complexity to find the answer. Let's get into it.
Okay, let's start where the money's made. The family of apps, FOA, Facebook, Instagram, Messenger, WhatsApp.
The cash engine.
Exactly. And looking at their numbers, this part of the business it looks incredibly healthy. FOA revenue drove almost all of that $51 billion total, up 26%.
It's firing on all cylinders. And I think what's really informative for you, the listener, is how they're pulling off this growth. On such a huge base already, it really comes down to two things happening at once. More volume and higher prices.
Which is key, right? They didn't just flood the zone with cheap ads to get the volume up.
Precisely. Ad impressions delivered, so the sheer number of ads shown increased 14% worldwide. That's solid growth. But crucially, the average price per ad also went up, 10% worldwide.
Okay, so double-digit growth in both volume and price. That explains the revenue surge.
Yeah, it's a powerful combination, and the filing actually points to the online commerce vertical as the biggest contributor there. So think shopping on Instagram, Facebook Marketplace. That seems to be really paying off now.
And they're still adding users, even at this scale.
They are. Worldwide daily active people, DAP, that hit 3.54 billion with a B, up 8% year over year.
The scale is just mind-boggling.
It really is. But, the metric that tells you if they're actually making more money from those users is ARPP, average revenue per person.
Right.
And worldwide, ARPP was $14.46 for the quarter. That's up 18% from last year.
18%, so significantly better at monetizing each user they have.
Exactly. Despite all the regulatory noise you hear about, the underlying ability to generate income per user is getting stronger. That shows some real business strength.
Okay, so FOA is the powerhouse. Let's switch gears to the future bets, Reality Labs, or RL, and the huge AI spending.
Right, the other segment they report.
How did Reality Labs do this quarter?
Well, revenue was actually up quite a bit, $470 million. That's a 74% jump year over year.
74%. Wow, what drove that?
Mostly hardware sales. MetaQuest headsets, those AI glasses they've been pushing.
Okay, but what about the bottom line for RL? Still losing money.
Oh, yeah. Big time. The loss from operations was $4.432 billion. Again, billion with a B.
$4.4 billion. Just in one quarter. Is that better or worse than last year?
That's the crucial part. It was basically flat compared to last year's Q3 loss.
Hold on. Revenue up 74%, but the loss is flat at $4.4 billion. That implies costs went up right alongside revenue, completely eating any gain. Where's the path to profitability there?
That is the question. And the filing pretty much spells out the answer.
Yeah.
It's all about the massive investment in AI infrastructure. Their research and development costs, R&D, just soared, up 35% in the quarter.
35% jump in R&D.
Yeah. And they explicitly say it's because of higher employee costs, hiring AI talent isn't cheap, and just building out the infrastructure. Servers, data centers, all needed to support what they call their generative AI and superintelligence initiatives. They're pouring money into it.
And it wasn't just internal spending, right? There was that huge external investment earlier in the year that showed up in the 9-month figures.
Absolutely. That scale AI investment. They spent, nearly $13.8 billion for a non-voting stake in scale AI.
$13.8 billion.
Out of about $18 billion total they put into these non-marketable equity investments over 9 months. It's a massive signal.
Yeah, it signals they're willing to write enormous checks to lock down key partners in the AI space, not just build it all themselves.
Exactly. It's about securing capabilities fast. And that definitely shakes up the competitive landscape.
Okay, let's circle back to that core mystery. We've got strong FOA revenue, big RL losses, but still. How do you get from $51 billion revenue down to an EPS of just $1.05? Last year it was over $6.
Right, $6.03 last year. It's a dramatic fall.
We need to understand this tax bomb. What happened?
It all comes down to the effective tax rate. For Q3 2025, it spiked to, well, an almost unbelievable 87%.
87%. How is that even possible? The normal rate is, what, like 20-something percent?
Usually much lower, yeah. Their rate in Q3 last year was only 5%.
5% to 87%? That sounds punitive. Did the IRS just decide to hammer them?
No, it wasn't an IRS decision like that. It was triggered by new legislation here in the U.S. Remember that big tax reform bill passed in July 2025? The filing calls it the One Big Beautiful Bill Act, or OBBBA.
Ah, okay, the OBBBA Act. I remember hearing about that. What did it do?
Well, it did a few things, like allowing immediate expensing for R&D, which sounds good.
Right.
But critically, it changed the rules around how companies account for deferred tax assets. These are basically future tax savings they expect.
Okay, so Congress changed the accounting rules for future tax benefits.
Exactly. And the immediate result of those new rules was that Meta had to take a massive, one-time, non-cash income tax charge.
Oh, massive.
Almost $16 billion. $15.93 billion, to be precise.
$16 billion charge, just from an accounting rule change.
Pretty much. It's related to something called a valuation allowance. Basically, the new law, specifically the new 15% corporate alternative minimum tax, or a CAMT.
The minimum tax on big companies.
Right. That CAMT limited how much Meta could count on using those future tax savings quickly. So accounting rules forced them to say, okay, we might not get the full benefit as soon as we thought, and take a huge write-down now.
So let me get this straight. Congress changes the tax law, which includes this new minimum tax. That forces Meta to take a nearly $16 billion non-cash accounting hit against expected future savings.
You got it.
And that's what tanks the net income and the EPS for the quarter. But it wasn't $16 billion in cash actually paid out in taxes this quarter.
Precisely. It's an accounting entry reflecting the impact of the new law. It's a big deal for the P&L this quarter, but not a direct cash drain of that magnitude right now.
Okay, that makes more sense. So is this 87% rate the new normal?
No, thankfully for them. The filing projects that the Q4 tax rate should go back to their more typical range, somewhere around 12–15%, assuming no other big changes.
So a massive one-time hit from tax legislation solves the core mystery.
Looks like it.
All right, so even setting aside that tax earthquake, Meta always operates under this, constant cloud of regulatory and illegal risk. Looking through the risk factors section in the 10Q, the potential scale is just, wow.
It really is. They have this standard disclosure language, but the number is jaw-dropping. They state the maximum aggregate potential damages or penalties across all their various legal fights could be up to hundreds of billions of dollars.
Hundreds of billions.
Yeah. Now, that's a theoretical maximum, not what they expect to pay, but it frames the sheer scale of the legal battles they're fighting constantly, all over the world.
And Europe seems to be a major battleground. Any updates on the big fights there?
A couple of key things. First, that huge fine from Ireland's Data Protection Commission back in 2023, the $1.2 billion one related to data transfers.
Yeah, I remember that.
Still under appeal. So that massive liability is still hanging out there. Second, and more recently, the European Commission ruled back in April that their subscription for no ads model, pay us or see ads,
right,
doesn't fully comply with EU requirements.
Yeah.
The final decision came through, and that could mean they had to change the model again or face more fines, possibly even this next quarter, Q4.
Always something in the EU. What about here in the U.S.? The FTC is still after them, right?
Oh, yes. The Federal Trade Commission is still actively trying to get the courts to modify that 2020 consent order they agreed to.
And what changes does the FTC want?
Substantial ones, including a really broad prohibition on using data from liners for any commercial gain. That fight is ongoing, and frankly, it strikes at the heart of some of their data practices.
So lots of ongoing risk, but the quarter also saw some actual outcomes, right?
Yeah.
Win in a law.
Exactly. A perfect illustration of the legal tightrope they walk. On the law side, there was the Flow Health case. This is part of the broader litigation around their Meta pixel tracking tool. On August 1st, a jury actually found against Meta for a specific class of California users. Now, the plaintiffs are asking for $5,000 in statutory damages per person for about 1.6 million people in that class.
Oof. 5,000 times 1.6 million. That adds up incredibly fast.
It does. You see how they get to that hundreds of billions
Uh,
potential ceiling pretty quickly when you factor in dozens of cases like this.
But then, on the flip side, a major win related to their biggest bet, AI.
A huge win, yeah. Really critical for their future strategy.
Mhm.
On June 25th, a court granted summary judgment for Meta.
Meaning they won without a full trial.
Exactly. The court agreed with their fair use defense regarding using copyrighted books to train their generative AI models.
That's massive. It basically gives them a legal green light to use vast amounts of public data, even copyrighted stuff, for AI training.
It's a very significant precedent, yes. It removes a major legal threat and really validates their approach to building these large AI models.
Okay, so we have this picture. Huge AI spending, massive legal risks, that one-time tax hit. It all requires a lot of financial strength, a lot of liquidity. How are they balancing all that with returning cash to shareholders? Are they still doing buybacks and dividends?
They are, yeah. Despite all the spending and the volatility, they kept up the capital return program. Over the first 9 months of 2025, they bought back and retired 40 million shares of their stock. That cost them about $26.3 billion.
26 billion on buybacks and dividends.
They actually increased the dividend earlier in the year, back in Q1, bumped it up 5% to about 52.5 cents per share per quarter.
So still prioritizing returning capital, but that's a lot of cash going out the door between the AI investments, the CapEx, and these returns. How's their cash balance holding up?
Well, it definitely went down. Their total cash equivalents, and marketable securities dropped by over $33 billion since the start of the year.
33 billion lower. Where did it mainly go?
The filing points to two main drivers.
Hmm?
About $50 billion in capital expenditures that's building the AI infrastructure, data centers, etc., and over $30 billion in those capital returns we just talked about, buybacks and dividends.
Okay, so big outflows. Are they worried about liquidity?
Management included a pretty strong statement of confidence in the 10Q.
Oh.
They basically said they expect the cash they have, plus the cash they generate from operations, will be enough to cover everything operational needs, funding investments, for at least the next year.
Right. That confidence really highlights the underlying strength, doesn't it? Even with a $16 billion tax charge, even with $4.4 billion quarterly losses in RL, the core FOA business just generates so much cash.
It absorbs the hits.
Yeah, absorbs the hits and keeps funding the future bets.
And that really brings us back to that core tension we identified at the start, right? You've got this incredibly profitable advertising machine funding these gigantic, expensive pushes into AI and the metaverse. But layered on top of all that growth is just extreme financial volatility from things like tax law changes and this persistent, almost existential level of regulatory and legal risk. Hashtag outro.
Absolutely. And that leads perfectly into the final thought we want to leave you, the listener, with today. Think about this. Meta is clearly prioritizing R&D for AI. They're spending billions on infrastructure, hiring top talent, and they just got a huge legal win basically okaying their use of vast data, including copyrighted works, for training AI.
A very aggressive push.
Exactly. So considering this aggressive, now legally bolstered push into generative AI and what they call superintelligence, what does that signal for the rest of the tech landscape? Who gets disrupted? And maybe more importantly for investors, how soon do those massive AI investments stop being just giant expense lines?
Yeah, dragging down earnings.
And actually start showing up meaningfully in the revenue column? When does AI start paying the bills instead of just creating them? Something to think about as you look at their strategy going forward.
Okay, that wraps up our deep dive into Meta's Q3 2025 filing. Thanks for digging into the details with us.
Yeah, thanks for tuning in.
We'll catch you on the next deep dive.